Hi everyone, a very good evening to all our viewers. And as always, I'm Karunya Rao. I'm back with a brand new edition of Money Control Markets Weekly. Joining me today is Gurmeet Chadha of Complete Circle. Gurmeet, thank you so much. It's always a pleasure having you on board. Thank you for joining in.
Likewise, Karunya. Thank you for having me.
Gurmeet, there's lots to talk about. We're almost at the end of the year. It's been a very, very exciting, eventful year and lots to look forward to as well. But as of now, if we look at what's happening in the market, right? Uh, November, as we all know, we've seen a fair amount of correction as far as the markets are concerned. We have been moving in a range for quite some time now, and in November, of course, uh, you know, opened up a whole other completely different tangent for the markets. There's been a fair amount of volatility, lot of uncertainty. Markets just seem to be oscillating up and down almost on a daily basis now. Tell us exactly in simple terms, what exactly is going on in the markets. What should retail investors, or how should retail investors look at it?
That's a good one to begin with, Karunya. And I think we've had a literally vertical move from the March lows last year, and probably this was for the first time Nifty went without a 10% correction. Mind you, at the index level, we've still not corrected 10%, but obviously there's been sharp sector rotation. So I think one fact has been that FIs have been pulling out money more out of secondary market. Even on days when markets are up this week or others, we did see some FI selling. There is a bit of a concern on one obviously is the COVID variant, whether this can create further inactivity or localized restriction on economic activity. Then we had the Evergrande news on China that had a bit of a negative impact on the commodities, and the biggest news is on the liquidity with some hawkish comments from the US Fed that they might want to taper a little more, and that reminded market of 2013. So I think it's a combination of factor, and I think markets also were due for some correction. So it's like you were looking for a reason, and there was some concerns on market, and some correction is good. It brings rationality back in the market. We have seen some rationality return in the IPO space. Almost everything was going up with no sense at all. We've seen some of the high multiples, 100 to 100 price to sales, 100 to 100 P multiple stocks getting some bit of correction. So I think there is some rationality getting restored, and a retail investor should view volatility as integral to investing. I think this is part and parcel. Once a year, about 10%, 20-25% once in 2-3 years, and one big drawdown between in 5-8 years. I think it's normal in equity. You look back last 20 years. So stick to a process, have asset allocation in place, and take advantage of the volatility if you have liquidity. Otherwise, just sit tight.
Right. But Gurmeet, what about the relentless FII selling? Should we be worried? Because yes, December typically is a lean period for most foreign investors and foreign funds. But starting January, can we again see the selling trend continue? What is your sense?
Well, November, December selling is also some part of profit taking, Karunya. And if you see the emerging market basket, if I'm a fund manager, Hong Kong, China, which is a large dominant portion of EM, hasn't delivered great return. In fact, is negative. And the other half, which includes India and some of the other markets, has done well. So some profit taking happens towards the year end. Uh, Very difficult to pinpoint how much they will withdraw. But one good positive part has been that a lot of the selling has been there's been some cushion because of domestic flows. If you see the November numbers, SIP numbers were 11,000 crores. Equity net inflows, which is X of arbitrage, was almost 20,000 crores. So a part of the selling, otherwise, if you see the selling, it's been a little about 50,000 crores. Some of it has got, I wouldn't say absorbed, but maybe, some cushion has come through to domestic buying. My own sense is, our growth numbers are looking good. Economic indicators are looking strong. I expect good earnings to come in a lot of pockets. My sense is you would see some FI flows returning next year. That's what my base case is, unless something very wrong goes on the global front or on the macro front.
Well, that's quite heartening to know, Gurmeet, and I hope our retail investors and viewers who are watching us, get some of that optimism and stay put instead of panicking or instead of getting anxious about their portfolio. Typically, Gurmeet, week after week, we get a lot of viewer engagement as well, given that this is a live show. And one of our viewer queries, even right now that I'm seeing on the screen, is whether this is the right time to restructure one's portfolio. Is the current dip in the market an opportunity to relook and perhaps accumulate or add stocks that they perhaps missed out on in the recent rally that we saw in the last 2, 3 months?
Very good query. And I think, I would like to reiterate that rebalancing has to be a regular process. It's not be dependent on whether the market has suddenly gone up or there's been a dip in the market. You should continuously, evaluate portfolio. Whether you need to action change weightages is a separate thing. I think there are few pockets which I think have corrected a little more, than related to the market, where fundamentals over the medium to long term are intact. I think some of the APIs and CRAMS businesses, I think the correction has been between 20 to 40%. In fact, some of the larger names also like Divi's is down almost 17, 18%. So I personally think the pharma outsourcing opportunity is pretty long term. Maybe if you are underweight pharma, you can add some of these API CRAMS names. Financialization of savings, if you see, to me again is a very secular trend. So look at, we've opened 1 crore demat accounts in 100 days. The number of SIP accounts which MP released is about 4.5 crores, a little over 4.7 crores in fact. Just compare this to the number of smartphones we have or number of bank accounts we have. I think it's a long way to go. So play the capital market participation. I think some of the private sector banks have corrected more, including some of the tier 1 banks corrected almost 20%. So financials can be looked at. So I think it's a combination. I think but one suggestion is, be where there is solid earnings growth, be where the fundamentals are intact, and be a little staggered.
So Gurmeet, where should one be then? Where are the fundamentals strong and valuations attractive? Do you have any themes that you like after this recent, downtake that we've seen, or correction of sorts that we've seen in the market?
Yeah, so few of them, as I said, I think markets also, we saw a beta rally in a lot of sectors, whether so anything which had word specialty chemical went up. Markets did not really differentiate. I think what you will see now is a differentiation basis, the more the market has and strong earning support. So I like some of the selected plays in specialty chemical. I think there's been a healthy correction, whether it has been Deepak Nitrite, it's been Aarti, Vinati, a lot of these names. I like some of the API and CRAMS names which I was speaking about, including Divi's, Loris, etc. of the world. I like this financialization of savings, which is the depositories, the asset management companies, the life insurance space, which I call non-banks. Some of the private sector banks, so look at, for example, something like ICICI, great, turnaround in last 2, 3 years, best asset quality metrics. I was attending their, digital analyst call. They added almost 4.5 million new to bank clients through their app. They have an iLens app which is into digital lending. A great app, Insta is into SME and business banking. So they are really taking digitalization to the next level, and they are collaborating with fintechs. I think I find this discussion on fintechs versus bank very overrated. I think possibly you will see more collaboration going ahead. And some of the digital themes. If you look at the profit of all IT companies today in India, all tech companies, is around 1 lakh crores, a little less than 1 lakh crore, which is about, let's say, 14-15%, of the overall profits. I think Stallion came up with this data. I think this profit pool and contribution of a lot of the technology companies will go up. So even some of the selected IT names, look good.
Gurmeet, since we're talking sectors, one of our viewers is asking if it's a good time to enter into insurance stocks at current valuations. And of course, insurance has garnered a fair amount of interest, whether it's retail investors or institutional, right? And with the impending LIC IPO coming up, it's only going to get stronger.
I agree, and there has been some time correction. I would say not as much as price correction in the insurance names, including life insurance and GI names. It largely because of COVID-led higher claims. The business activities are also impacted. I think you probably will see another quarter of heightened claims, and then I think, but the so for something like an ICICI Lombard, for example, has been consolidating with one of the stronger plays in the entire general, and it's a more comprehensive play in the entire general insurance space. Covers auto, covers health, covers other protective spares. So life insurance, I think HDFC Life has seen a decent consolidation. So I think insurance, to me, again, LIC market share, since you pointed out, is about 70%. And I think insurance companies are where private banks were 10 years back. So the industry will grow, and the private insurers will probably keep getting more market share.
Okay. What about banks, especially public sector banks? Because week after week, we are asked a lot of questions about public sector banks. Of course, the coverage there is very limited, even now, only barring a few names like SBI. But overall, how do you view the space, especially after the NPA restructuring, that is underway? Do you see things looking up there?
You have to be selective. We have seen in last 10 years a lot of news on public sector banks. Whether that's been infusion of capital by the government. Now there is obviously a bad bank being created. So at a broad level, I think the worst of the corporate NPA cycle is behind. But you have to be selective here. I personally would not try and go beyond SBI. And SBI, if you see last 3 years, their gross NPAs are down 43%. The credit cost guidance they gave, they've adhered to it. If you see the restructuring book, it's been almost at par with some of the private sector banks, consistently showing improvement in all operating metrics, whether it is NIMS, CASA. That NPA number I pointed out has coming down. All subsidiaries doing well. SBI Life doing well. SBI Asset Management is the number one asset management company. SBI Cards number two, number three by both spends and number of cards. So I think all subsidiaries are doing well. Still at about one book value FY23. So I would not go beyond SBI, but if you get some more good news and you really see a good credit cycle picking up, you might want to be a little tactical. But for personally, I would not go beyond SBI.
Okay. Earlier on in conversation, you were talking about Evergrande situation and how it played out. But going forward, do you see any impact on Indian markets, the way things are panning out there? Could there be any, pockets like, say, commodities, metals, etc., that could be impacted?
There can be some impact. While I think when the first news came of when the first default news came about, almost I think 4 6 weeks back, I think post that China has cut rate, their RR rate by 50 basis points. There is a medium lending facility which I think they are likely to roll over in December, so that needs to be watched out for. And they made a comment that this is a market event. So I think the comment coming from the various authorities there probably are telling you that it would probably not lead to a contagion, but I would like to wait and watch. It would have a bearing. It's a we would like to see whether it really triggers a broad contagion or not. Of As of now, looks like should be contained, and maybe in few pockets. And we already saw some reaction in commodity prices as well as commodity stocks. Karunya, if you see most of the commodity stocks, if you see whether ferrous, non-ferrous names have corrected 20-25%, but need to be watchful and keep an eye on it.
So still perhaps stay away for some more time from metals, is it?
Metals obviously have to be part of the satellite portfolio, not the core portfolio. They follow cycles, right? Last 10 years, the return from 2009 to 2019, most metal stocks gave negative returns. Only in last 1.5 years, you've seen a return. I'm a believer that we are in for I'm not saying super cycle of commodities, but a good cycle. I think there are early signs of real estate picking up. There's a broader investment capex cycle playing out. US is doing more than $1 trillion infra revamp there. Overall, I'm constructive there. But as I said, these short-term events like this can give you sharp volatility. So you just have to be a little watchful and watch for your because when you are tactical, you have to get your price points right.
Right. What about IT space? I mean, given the way a lot of these sectors and themes have seen, some amount of correction in their prices. IT relatively has been stable. Is it likely to, stay strong, or do you see some challenges there as well in the coming few quarters?
So I think the IT, the tech cycle, I think is there for longer. I think we are very early into whether it is cloud migration, whether it is the next generation of digital service we are seeing. But now you got to be selective in terms of differentiating what you are putting, because the valuations are, you're getting Indian IT services company at 30-40 p, and Apple, despite being near to $3 trillion, is still 28-29 p, right? So I think you have to have a slightly more comprehensive portfolio. Maybe some exposure to a Nasdaq ETF will also not harm you. So I think Infosys, for example, so within the larger name, I think if you should watch for the deal TCV. You should keep watching for which companies are able to maintain margins, because attrition is an issue. Which companies are able to reskill, repurpose talent. What is the composition of deals they are getting in terms of the transformation deals as well as the annuity deals. So we like Infosys among the mid caps. Mindtree is one company which continues to deliver 20% plus kind of margins, and they continue to guide for it. Dependence on the top client has also come down, and I was looking at this non T1 accounts which they have. That proportion is picking up, bringing more granularity there. So be a little mindful of valuations, but IT in general, if I were to have a 3-5 review, still pretty constructive on it.
Okay. If we look at the big picture and what's happening as far as the macros are concerned, everybody on the street is talking about Fed meeting, right, which is coming up next week. What is the outcome that you are foreseeing, and how could it impact Indian markets?
Uh, Very difficult to say right now. I think that, as I said, the comments of last a week or so have been a little more hawkish than earlier, and point towards tapering. Um, my personal sense is that with this new variant, I think looks like the normalization has to be more calibrated and not sudden. Some markets, although have done interest rate hikes, including Brazil, including a lot of other economies. So we have to be a little careful here. But as long as the bigger parameter to track here is the 10-year US bond, as long as the tapering or normalization keeps the US 10-year under 2%, the negative impact on equity would be marginal in my view. So the key thing to watch would be, for me, would be the bond yields and the pace of normalization. My sense is it will be calibrated, and the 10-year should be anchored well. But if in case there is a sharp spike in US yields, that can have a negative impact on emerging markets, including India.
But overall, if you look at other macro developments back home, anything that you will be watchful of?
As I said, I would be watchful of the margin pressures now, how they are, which are the companies which have the pricing power. We have seen a lot of companies doing price hikes, even in Q3, uh, and some of the commodity prices have softened. So I think this is where the differentiation will happen. People who are able to manage supply disruptions better, manage raw material cost inflation better, have the pricing power, will get differentiated in the sector. And that's why I said that looks like it's not going to be a beta rally with everything going up. You got to be more selective. You need to up your guard, research well, and go where there is these parameters which are giving earning support, which I spoke of.
Okay, makes sense. Um, I cannot let you go without talking about what's happening in the primary markets. 2021 single-handedly is the year of, the IPOs. But off late, if we look at Paytm, if we look at a Star Health, the subscription levels or the frenzy has not been as high. Do you think the retail investor is now more prudent, more aware, more well-researched, and knows where to jump onto the bandwagon and when to stay put? What does it tell you about the new investor?
I think it's a learning curve. I think it started off with investing almost in everything and anything which came, and then you obviously have you learn some lessons the hard way. The market keeps teaching you, the old lessons every time and again. And there's this saying in stock market that, prices go up on stairs and come down in an escalator. And I think now the markets are also differentiating. So we've seen some great IPOs even in last couple of months, including Latent Few, including some of the others. And we've seen some markets which were not priced well, where the companies did not have, specific economic mode, markets differentiating. I think that will continue. And I think, one has to be a little careful that there is no shortcut to make money. There is no easy money which can be made sustainably over long. It does get average out. So just don't buy IPO because, there is IPO and there is a gray market premium and all. If that fits well into your portfolio, if you understand that business. So some of these tech spaces, for example, are here to stay. I think ad tech, I think a lot of the fintech names, a lot of the companies which are going direct to consumers in a lot of products, I think have great business models. They are here to stay, but you need to differentiate and don't overpay just because of the euphoria.
Any of these businesses that interest you, Gurmeet? The ones that are already have listed, or the ones that are yet to come into the market?
Yeah, some of them do. As I said, I'm pretty gung ho on data analytics, but obviously the price jump makes some of the. So one is whether you like the business in terms of future. The second is, you would not want to overpay, those 100 to 200 multiples. So I like advertisement tech. I think the screen time today, if you see, is about 6-7 hours for everyone, right? And we have 75 crore smartphones. So I think companies into digital advertisement, the SaaS platforms, I think will continue to do well. I like a lot of, the fintech names. Within fintech also, there is a lot of diversity. I also think the likes of CDSL CAMs are also fintech. I think they are so used to only clubbing the freshly ones listed there. So these are some of the themes I like. I would also be interested in cyber security. I think you will see more ideas coming there as well. So selectively, yeah, I like some of the new themes.
Gurmeet, you're based in Delhi, and we've been seeing a lot of these clippings and videos of Delhi airport and how badly flooded it is. So when we talk about revenge travel or reopening trades, whether it's aviation, hospitality, QSRs, or fashion and apparel, any of these revenge trades that you like right now?
It's very, while we enjoy clubbing them and giving them fancy names, but I would be a little mindful of, we don't know how this virus variant is going to play out. I don't think so this is a time to get very adventurous right now in the market. Value, focus on capital preservation also. I think if you want to play, let's say out of home consumption, which if I were to give it a broad category, I think some of the QSR names are good. So something like a Jubilant Food, if you see, more than 80% deliveries still happen on their own app. They have a great distribution fleet. They use a lot of data analytics to customize their menu. And also, I think it's actually a food tech play, if you ask me. And they have the ability to have that mix of online ordering and dining taken care of. Also, selectively, maybe if you get some bargain deals in hotels, let's say, for example, Indian hotels, 20,000 plus room inventory, great brand. They're moving into an asset light model. But as I said, it has to be a more bargain deal. At current prices, seems that entire revenge traveling seems to be priced in.
So apart from this, any other no-nos that you have right now on the street which are still looking expensive, or where you're yet to see meaningful earnings recovery?
So I think just don't play hype right now. Just don't play something which I would call a hurt trade. Do not leverage. I think there is a temptation that an X stock is down 20%, 30%. I think it should go up. Let me leverage, and so avoid leverage. And as I said, research well. Go up a notch. If you're not understanding it, go for an indexed investing. Take a passive ETF. I think that should help you. Focus on owning businesses, right? Do not just focus on price movement. Good businesses going through temporary bad periods are usually great opportunities. So focus on value, not just price correction.
Gurmeet, we're just about 3 weeks away almost, from the new year, 2022, and 21 has really been very eventful, good, bad, and, in all possible ways for the markets, for from a COVID standpoint and everything else. But 22, how do you see it playing out, and what will be some segments that you will be keeping on your radar or which you think have good potential to do well in the coming 1 or 2 years?
So, I think my
What
first
will
clear.
be, simply put, what will be the theme or the sector for the next year?
Uh, I think India is the theme. I think this. I've said this multiple times. I think this we are looking very good. I just pray that this health pandemic is behind us, and we don't get more variants, no more losses of life. And again, I think assuming that, and hopefully, fingers crossed, I think we have great economic recovery ahead. We already seen the GDP print come in. I think we are poised to grow at 8-9% GDP, and maybe in nominal terms 14-15%. And I think that happens. I think everything would be taken care of. Just don't make mistakes. I think if we keep it simple, do not make too many mistakes. I think equity is as much about not making mistakes. And as I said, I like some of the tech plays. I like some of this. I think we will be the one of the global pharma outsourcing is a great opportunity. Tech is a good opportunity, and I also like some of this. I also see this housing. I think there's a huge recovery in real estate, and once real estate recovers, it contributes significantly to the entire profit pool. Almost 100 odd sectors are dependent on real estate. So overall, things are looking good. I just hope that health-wise and science comes to our rescue, and this pandemic is put to rest.
Well, Gurmeet, you like tech, but do you also like technology such as EVs? Do you think one should start buying and looking at companies which could have EV exposure?
I think rather than only looking at EV, you should have an energy basket, Karunya. And I think we don't
Okay.
know, how this is going to pan out. So I think you should have, people who are getting into cleaner energy also. Whether it is hydrogen, whether it's solar. Look at Reliance, for example, the acquisitions they have done on battery storage, on solar, the own capex plan which they announced in the AGM. Look at companies which are providing, let's say, the EV infrastructure and the basic raw material. You call it as an entire EV ecosystem. Something like Tata Power, for example, which is actually providing charging infrastructure, also has a great solar EPC book also. And you have to also look at, because it is India, and a large part of it is rural economy, the ethanol and the cleaner variants there. So I think got to make an energy basket, in my view, rather than just blindly play one particular segment, which is EV. But I think energy would be very transformative, and reason is that a lot of disruption will happen. So you got to own it comprehensively and hope that you get a few of them right.
Okay, great. Gurmeet, thank you so much for joining in. We're running out of time, so unfortunately, I mean, that's all we can, talk about in today's episode. But always a pleasure chatting with you and getting insights on the markets. But before we let you go, Gurmeet, I want to ask you, just like the way you tweet, what is overrated and what is underrated when you look at the markets? Do you have any 2 cents to share on that?
I think what is overrated right now is a lot of the hype around, new age companies, startups. I think a lot of startups will become unicorn. We have had 40 unicorns this year, and last Q3, every dollar China got, we got $1.5. So I think the system is thriving. But I think what is underrated is the ability of some of the old companies to pivot and turn it
Hmm.
around. I think strike a balance between this new age and old age. This is never this versus that. Always strike a balance, and I think your portfolios will do well.
And you rightly said, because unicorns were called unicorns because there was a time when they were so rare to find and rare to spot. And now, it's also been the year of many, many unicorns for the Indian startup space. So, yeah, new age tech is overrated, and legacy, old, solid companies are underrated. On that note, Gurmeet, thank you so much. We wish you all a very happy 2022 from everybody at Moneycontrol. And thank you once again for tuning in and for joining us, Gurmeet.
Thanks, Karan. Thank you so much.